Imagine going to buy a car and being told that because of your credit score, the interest rate on your loan is going to be 18% instead of 6%. On a $25,000 car loan over 5 years, that difference costs you an additional $8,500 in interest. Not because the car costs more, not because you negotiated poorly, simply because of a 3-digit number that determined how much risk the lender decided you represented. Now imagine that same dynamic playing out on a mortgage. The difference between a good credit score and a bad one on a $300,000 30-year mortgage can easily represent $60,000 to $100,000 in additional interest paid over the life of the loan. $100,000. Gone. Not because you made bad investment decisions or because the market moved against you, because your credit score was lower than it needed to be at the moment you needed it most. A bad credit score is not just an abstract financial metric that lives on a screen somewhere and has no real-world consequence. It is a tax, a continuous, compounding, invisible tax on every major financial decision you make. Every loan, every mortgage, every rental application, sometimes even every job application in industries that check credit as part of background screening. And unlike most taxes, this one is not set by a government you have no control over. It is set by a system you can actively influence, improve, and ultimately master if you understand how it works and what specific actions move the needle most efficiently. The good news, and this is real good news, not the motivational fluff kind, is that credit scores are not fixed. They are not permanent judgments about who you are or what you have done in the past. They are living, dynamic calculations that update every single month based on the information in your credit file, which means every month is an opportunity to move the number upward. And with the right sequence of actions, the speed at which a damaged credit score can recover is faster than most people believe possible. Today, I'm going to walk you through the exact proven steps to fix a bad credit score in 6 months, not overnight. 6 months is the honest timeline for meaningful, sustainable improvement that reflects real changes in your credit behavior and profile. Not tricks, not loopholes, not the kinds of shortcuts that credit repair scam companies sell. Legitimate, permanent improvement built on the factors that the credit scoring models actually care about. Welcome to Klux One Finance. Before we talk about fixing your score, we need to make sure you understand exactly what your credit score is and what it is not. Your FICO credit score is a 3-digit number between 300 and 850 that represents a statistical prediction of how likely you are to miss a payment by 90 days or more in the next 24 months. That is it. It is a risk prediction tool used by lenders to decide whether to extend credit and at what interest rate. It is calculated from the information in your credit reports at the 3 major bureaus, Equifax, Experian, and TransUnion. And it is updated every time those bureaus receive new information about your accounts. The score is calculated from 5 specific factors, each weighted differently, and understanding those weights tells you exactly where to focus your repair efforts for maximum speed and impact. Payment history is the largest factor, accounting for 35% of your total score. This is simply whether you have paid your bills on time or whether you have late payments, collections, defaults, or bankruptcies in your history. A single 30-day late payment can drop a good score by 60 to 110 points. Multiple late payments or a collection account can be devastating. But here is the critical insight. Payment history is also the factor you can start positively influencing immediately, beginning today with the next payment you make. Every on-time payment from this point forward is a positive data point being added to your file. The damage does not disappear instantly, but it becomes increasingly diluted over time as new positive history accumulates around it. Credit utilization is the second largest factor at 30%. This is the ratio of your credit card balances to your credit limits, and it is the fastest moving factor in your credit score. Unlike late payments, which take years to fully fade from your score, utilization can change dramatically from 1 month to the next. Pay down a large balance and your score can jump significantly at the next reporting cycle. Run your balances back up and it falls just as quickly. Utilization is the lever with the most immediate impact on your score, and it is the first place we are going to attack in the repair sequence. Length of credit history accounts for 15% of your score, reflecting how long your accounts have been open, how long since you last used them, and the average age of all your accounts. This is the factor you have the least control over in the short term because it is literally about time. You cannot manufacture years of credit history. What you can do is avoid actions that shorten your average account age, like closing old accounts, and take actions that eventually add more time as the months pass. Credit mix is 10% of your score and reflects the variety of credit types in your profile. Credit cards, installment loans, mortgages, student loans, auto loans. Lenders like to see that you can manage different types of credit responsibly. This factor matters less in the repair phase and more in the long-term building phase, but it is worth being aware of. New credit is the final 10% and reflects how many new accounts you have opened recently and how many hard inquiries appear on your report from credit applications. Each hard inquiry drops your score by a small amount temporarily, and multiple new accounts in a short period signal potential financial distress. During the repair phase, you want to minimize new credit applications to the bare minimum necessary for the strategy. With those 5 factors understood, here is the repair sequence, ordered for maximum impact and speed. Step 1 is pulling your full credit report from all 3 bureaus, not your credit score, your credit report. These are 2 different things that people frequently confuse. Your credit score is the number. Your credit report is the detailed document from which that number is calculated. And it is the credit report that tells you exactly why your score is what it is and what specifically needs to be addressed. You are entitled to 1 free credit report from each of the 3 major bureaus every year through annualcreditreport.com, which is the only federally authorized free report site. Pull all 3 reports, Equifax, Experian, and TransUnion, because the information in each one can differ. Not all creditors report to all 3 bureaus, and errors that exist on one bureau's report may not exist on another's. You need to see what all 3 say about you to build a complete picture of what you are working with. Step 2 is disputing every error you find, and this step has the potential to produce the fastest and most dramatic score improvements of any action in the repair process. The Consumer Financial Protection Bureau has found that 1 in 5 consumers has a verifiable error on at least one of their credit reports. 1 in 5. Errors that are inaccurate, unverifiable, or outdated are legally required to be investigated and removed from your report if the investigation confirms they cannot be verified as accurate. A single significant error removal, a collection account that was paid but still showing as open, a late payment that actually was on time, an account that was never yours, can move your score by 20, 30, 50 points or more in a single reporting cycle. The dispute process is straightforward but requires documentation and follow-through. For each error you identify, write a formal dispute letter to the Bureau reporting the error. Identify the specific item you are disputing. Explain clearly why the information is inaccurate. Include any documentation you have that supports your position. Bank statements showing on-time payments, letters from creditors, proof of account closure. Send the dispute by certified mail with return receipt requested, so you have proof of delivery and a paper trail. While you wait for disputes to resolve, you move immediately to step 3, which is attacking your credit utilization, because this is the fastest lever for score improvement that you can pull right now without waiting for anything to be investigated or removed. If your credit card balances are high relative to your limits, paying them down is the single most impactful action you can take for your score in the short term. The goal is to get your overall utilization below 30% as quickly as possible and below 10% eventually if you want to fully maximize your score potential. On each individual card, keeping utilization below 30% matters as much as the overall ratio across all cards. Step 4 is becoming obsessively on time with every payment from this moment forward. Every single payment, not just your credit cards, your utilities if they are reported, your phone bill, any loan payments, any accounts that report to the credit bureaus. Every payment on time, every month, without exception. If your score has suffered from past late payments, the only thing that heals that damage over time is an unbroken record of on-time payments going forward. Inability to pay can drop your score dramatically and take years to fully recover from. Step 5 is adding positive history to your file as fast as possible. And there are two specific tools for doing this that work better than almost anything else for someone in the credit repair phase. The first is a secured credit card. A secured card works by having you deposit cash as collateral, typically $200 to $500, which becomes your credit limit. The card reports to the credit bureaus just like a regular credit card, meaning every on-time payment you make with it adds positive payment history to your file. For someone with damaged credit who is having difficulty being approved for regular credit products, a secured card is the most reliable path to adding positive information to your report while building the habit of responsible credit use. Use it for one small recurring purchase each month. Pay the full balance before the due date and let the positive reporting do its work. The second tool is becoming an authorized user on someone else's credit card account. When a trusted family member or friend with excellent credit adds you as an authorized user to their account, the full history of that account, its age, its perfect payment record, its low utilization, can appear on your credit report. If they have had the card for 10 years with a spotless history, you may suddenly have a 10-year-old account with perfect payment history showing on your report without having had any involvement with that account. The impact on your score can be significant, and it can happen very quickly. The key is that the primary cardholder must have an excellent credit profile, because if they have negative history on the account, that negative history will appear on your report as well. Now let us talk about what to realistically expect on a month-by-month basis over the 6-month repair timeline, because managing expectations is as important as the strategy itself. In the first month, the work is investigative and administrative. Pull your reports, identify errors, send dispute letters, set up autopay on every account, request credit limit increases. This month produces little to no visible score movement, but lays the entire foundation for what follows. In the second month, if disputes have been resolved and errors removed, you may see your first meaningful score jump. Error removals, when they involve significant negative items, can produce score increases of 20 to 60 points or more in a single reporting cycle. At the same time, any utilization improvements from limit increases or balance paydowns will begin showing in your score as your card issuers report updated balances to the bureaus. In months 3 and 4, the accumulation of on-time payments continues building positive history. Any secured card you opened in month 1 now has 2 to 3 months of perfect payment history contributing to your score. Your utilization, if you have been actively managing it, should be continuing to trend downward. Scores in the low 500s can realistically be in the mid to upper 500s or low 600s at this stage if the error removal and utilization work has been effective. In months 5 and 6, the positive history is beginning to compound in a meaningful way. 6 months of perfect payment behavior on top of utilization improvements and error resolutions puts most people in a meaningfully different position than where they started. People who began at 500 can reasonably expect to be at 580 to 630. People who started at 580 to 600, which is a common range for someone with a few negative items and high utilization, can often be in the 640 to 680 range by month 6 with consistent execution of this strategy. Some people see even more dramatic improvements depending on what specific issues were dragging their score down and how effectively those issues were resolved. What 6 months does not fully heal is a recent bankruptcy, multiple recent collections, or a pattern of very recent late payments. Those items continue to impact your score for longer than 6 months, regardless of what other positive actions you take. But even in those cases, 6 months of the right behavior dramatically softens the impact and sets the trajectory in the right direction. And trajectory matters. A score of 600 trending sharply upward is meaningfully different in the eyes of many lenders from a score of 600 that has been flat or declining. Credit repair is not a mystery, and it is not something that requires you to pay a company several $100s to do on your behalf. Everything a credit repair company can legally do, you can do yourself for free. The Fair Credit Reporting Act gives you the same dispute rights they use. The strategies for improving utilization, adding positive history, and building consistent payment behavior are the same strategies a reputable credit counselor would recommend. The only things you need are the knowledge, which you now have, the patience to execute the sequence in order, and the discipline to build the habits that your credit score will reflect back to you month by month as the number climbs. Start today. Pull your reports. Find the errors. Begin the sequence. 6 months from now, you will be looking at a fundamentally different number and a fundamentally different set of financial opportunities available to you because of it. Subscribe to Clux One Finance if you have not already. Hit the bell notification so you never miss a video, and I will see you in the next one.